Hi everyone, my name is Laura Lungarini. I'm a geologist by background. Since 2008 I work in NECST as an oil market analyst. The group I belong to is in charge of oil market scenarios. We analyze the oil market and we build the short, medium and long-term oil scenarios about price, demand and supply. Oil is, today crude oil is a commodity and no other commodity reaches its complexity. With these few slides, I would like to introduce you in the oil market. First of all, I will talk about the parameters acting on oil price, and I'll show you how to evaluate the price of a crude oil. At the end of the presentation, we'll analyze the trend of oil price in the last few years, with particular attention to the crisis we have been experiencing in the last 18 months. To understand crude oil market, we have to take into account a lot of constraints acting from the field to the refinery, that is from upstream to downstream. First of all, logistic, commercial and strategic choices of the operators, strictly connected to economics, set out which is and how is the composition of a crude. There are over 200 of crudes traded worldwide, each one with its own characteristics. Midstream is also very important. When you have a new field and you produce a new crude, you can choose to build new infrastructures, new pipelines, or you can decide to exploit the existing ones. So in this case you mix your new crude with other crudes of the region, and generally speaking most of the crudes traded worldwide are blends of regional production. To understand the crude oil market, we have to take into account the different constraints acting on price and on crude from the field to the refinery, that is from upstream to downstream. First of all, logistic, commercial and strategic choices of the operators, strictly connected to economics, settle on which is and how is the composition of a crude. There are over 200 different crudes marketed worldwide, each one with its own characteristics. Midstream is also very important. When you have a new field, you can build new infrastructures to move the crude, or you can choose to exploit the existing ones. Most of the marketed crudes are blends getting together regional production. These crudes go into hundreds of refineries with their own structure and capacity to produce petroleum products that have various demand patterns differing according to national and regional local requirements. Crude oil is also political and global in its nature. What is behind the oil price? Oil's glut, which implies low price or its scarcity, has a huge significance for the global economy. A glut has a profound effect on the economies of most producing countries. Oil revenues represent the main income for some countries, and low price frequently requires a rapid reduction in national budgets. In scarcity, as prices rise, the economic consequences can be literally deadly because almost everybody on the planet needs petroleum products. The strategic and political nature of crude has many facets. Certainly oil is a strong element in many alliances, not least the one of USA with Saudi Arabia. But it is also the source of numerous wars and a factor of conflict within some states too. Crude reserves can create conflicts over the rewards of oil production, ranging from corruption to civil war. Think about Angola, Nigeria, Sudan. This graph in the slide shows the oil price history and the main events which affected it. Wars in big producing countries, such as the Iran-Iraq conflict in 1980, demand and financial crisis in key consumer areas. Think about Asia financial crisis in 1997 and the global financial crisis in 2008-2009. And big supply changes such as the tight oil boom in USA in the last few years and strategic decisions, especially from OPEC. We can recognize three main factors behind the oil price. Fundamentals, which include everything concerning with the dynamic of demand and supply and the choices of big market players. Geopolitics, related to turmoils in some important producing countries and international political tensions. Think about Arab Spring, Libya civil war and the Iranian embargo in the last few years. And last but not least, the financial market, where commercial but also non-commercial operators, including speculators, act. And today, above all, oil is a commodity. About fundamentals, the demand-supply imbalance is one of the most important parameters to take into account when we analyze oil price. Let me say, this is the first issue monitored by analysts. Generally speaking, a oil glut implies low prices, while oil shortfall is connected to price rise. In the last 2 years, oil balance has been characterized by a persistent oversupply, and the result has been a price plunge. So also huge building of oil stocks is a bearish factor on oil price. That is today's scenarios. OECD oil stocks stand at a record near 3 billion barrels. In this slide, we see the main players in the oil market. OPEC is an organization of 13 petroleum exporting countries founded in 1960. They account of 43% of global oil production and 72% of the world's oil reserves. 2/3 of this oil is in Middle East, and Saudi Arabia is by far the largest oil exporter in the world, with enough capacity to function as the swing producer to balance the global market, and it serves as OPEC's de facto leader. International Energy Agency is an organization established in the framework of the OECD in 1974, in the wake of the 1973 oil crisis. The agency was initially dedicated to responding to physical disruptions in the supply of oil, and as well as serving as an information source on statistics about the energy sectors. Today, its mandate has broadened to focus on energy security, economic development, and environmental protection. USA has always been the world oil top consumers, and in 2014 overtook Saudi Arabia and Russia as the first oil producer, and enters in the top 10 reserves holders. Russia is a key producer. After the industrial crisis at the beginning of the post-Soviet era, the country registered a strong rising in crude oil production, about 60%, and in 2014 it is the third oil producer. China is the second world consumer. In the last few years, it is the driver of oil demand growth. Other important players in the oil market are oil companies, traders, brokers, and the financial institutions. Geopolitics is another key factor acting on oil market and impacting on oil price. Geopolitical risk uses to be bullish for oil price. Since 2011, more than 3 million barrels per day of oil have been coming out of the market, especially because the Iranian embargo and Libyan crisis. Starting from 2014, the significant loss in volume, that is an upside risk for oil price, has been more than offset by the boom of oil production from US. In fact, US growth from 2011 to 2014 has been 4 million barrels per day. In this slide, we speak about financial market. Since late 80s, oil has been trading as a commodity in the main international future exchanges. In the last few years, the number of paper traded volumes and the number and type of operators, including speculators, strongly increased. China's stock crisis is the last example of the impact of financial market on crude oil price. With the so-called Shanghai effect, last summer, uncertainty on the impact of China's slowdown has been the main driver of the oil price fall. Now we see the benchmark crude oils. These are the most important crudes in the world, let me say. First of all, Brent. Brent is the European benchmark and is also the international benchmark. It is the marker for most of the commercialized crude around the world. Basically, Brent is a high-quality brand produced in the North Sea, UK, and the production started in 1978, and in 1985 the Brent blend as a whole saw its largest volume, 870 kilobarrels per day. Brent is the world's highest profile crude stream. There are also some regional benchmarks. WTI is the benchmark of North America crude oil market. Urals, the Russian crude, is another benchmark for the European market. Dubai, which is a Middle East crude, and Tapi are the benchmarks in the Asian market. Brent and WTI are the benchmarks traded in the International Future Exchange in London and New York. Which Brent? Brent, the international benchmark, is a complex of three interrelated markets: spot, forward, and futures, each with different characteristics and functions. Analysts use prices published daily by providers, which make the assessment of crudes and products in the regional markets. Platts is the most important energy price provider. Dated Brent is a benchmark assessment of the price of physical light North Sea crude oil. It refers to physical cargoes of crude oil that have been assigned specific delivery dates. Brent has all the key characteristics of a benchmark: high volume, consistent quality, security of supply, diversity of sellers, and broad acceptance. Brent, dated Brent, represents the reference point for the trading of 75% of the crudes around the world, 75%. In contrast to the trade in physical cargoes, a transaction in the forward Brent market is a commitment to supply or lift Brent during a specific month in the future. The forward market is an elite market, let me say, where only the most important commercial operator can trade, and it can be classified as an informal market. ICE Brent is a future contract launched in 1988. The contract is based on cash settlement and not on physical delivery. These contracts are standardized in terms of quality, quantity, and settlement dates. The future contracts are traded on regulated future exchanges, and it represents a broader range of participants. With futures, buyer can lock in the price of a commodity several months, even years in advance. Today, Brent price and Brent forecast are affected by both physical and paper markets. As you can see from the chart in the slide, today the physical market is only an irrelevant fraction of the global business, which generates the price of oil. Let's see in the next slide how to calculate the price of a crude oil. Starting from the benchmark. Think about Brent as the international benchmark. A crude price is the result of a benchmark price and a differential. The differential is dependent on three factors: crude quality, logistic and processing, and market. About quality, generally speaking, the lighter the crude, the higher the relative price. Logistics and processing is everything related to transportation and refinery system. We have to take into account the distance to cover till the refinery and the refinery system structure. Market is the factor which breaks the rules. In fact, market is affected by the supply-demand balance, the actual stocks and logistics, but also by expectations, competition of similar crudes in the same market. So exceptional events and structural changes can create distortions in the differential assessment. In the next slide, we see an example of a differential and an example of an inversion, a distortion of a differential. In the US market, in the last few years, there was an inversion of this historical differential between WTI and Brent. The historical premium of WTI, the US benchmark, versus Brent, the international benchmark, was based on a quality premium. Tight oil boom dramatically increased production in USA, where crude export was banned. Because of the huge increase in production, the historical premium of WTI versus Brent turned into a sharp discount till minus $20 per barrel in few months during 2011. Today, WTI is getting stronger because of the decreasing of US production. And moreover, last December, US Congress opened the door to overseas shipments, also with the purpose to avoid, in the longer term, the big discount in the 2011-2013 window. So let's see the trend of oil price in the last few years. When we speak about oil price, we refer to Brent, the international benchmark. In this slide, you see the dated Brent. You can see that from 2011 till 2013, crude oil price fluctuated in a range above $100 per barrel, shaped by two opposite forces: macroeconomic risk, which pushed down prices, and geopolitical risk, which was acting as a bullish factor on oil price. Starting from July 2014, the incessant fall. So let's see what happened in the last 18 months. Oil prices sank to $12 year's lows at the beginning of 2016, after a huge and long decline which started during the summer of 2014. Four main factors behind the price fall. First of all, a strong dollar, which is the currency used to trade crude oil. The large oversupply and the new OPEC strategy on the fundamental side. The oversupply, which has been lasting for 8 quarters, have been produced by US tight oil boom, but OPEC strategy made it worse, let me say. In fact, OPEC, in particular Saudi Arabia, changed its policy. Generally speaking, OPEC used to be a balancing actor in the oil market, adjusting its production to maintain oil price in a sustainable range. That is, cutting production during a price collapse and pushing output when price is too high. During this oil crisis, OPEC strategy has been changing. In order to increase market share and hit US production, OPEC countries keep on pumping oil on the market instead of cutting output. About geopolitics, the agreement on the Iranian nuclear program was another factor pushing down oil price. The end of the embargo from US and the European Union will result in additional crude volumes ready to be poured into the market, exacerbating the surplus. On the financial market, speculators got out of the oil commodity, and in the last few months, China's stocks crisis accelerated the fall of price. About price forecast, the International Energy Agency estimates that the oil market is facing the prospect of a third year of oversupply in 2016, and among the oil market analysts, there is a consensus about a low price environment in the short term.